What if the world's most trusted currency is losing its grip, and a 5,000-year-old metal is taking its place? Gold is hitting all-time highs, with its price teetering just below $4,000 per ounce as of this recording. By the time you're watching this, that number might have shot up even further. Adjusted for inflation, gold has smashed its previous records from the 1980s. This year alone, it surged by a staggering 52%, outpacing heavyweights like the S&P 500, the Nasdaq, and even real estate in some markets. Why is this happening? What's gold's true role in today's world? Will it keep climbing? And most crucially, what does this mean for the global economy and investors? Stick around, because we're about to unpack it all. At first glance, this kind of performance might seem more like a speculative cryptocurrency than an asset that's been a store of value for over 5,000 years. But here's the thing, this story isn't just about gold's price. All signs point to a seismic shift. Soon, global central banks' reserves may hold more gold than U.S. Treasury bonds, a phenomenon not seen since 1996. The unstoppable rise of gold in central bank reserves, growing concerns over inflation, the deteriorating fiscal health of the United States, questions about the Federal Reserve's independence, and geopolitical instability are raising doubts about the long-term stability of Treasury bonds, traditionally the world's safest asset. In response, many central banks are turning back to that barbaric relic gold. Some sources even suggest this shift has already happened, marking a turning point for Treasury bonds as the go-to safe haven asset. But it doesn't stop there. Gold hasn't just surpassed Treasury bonds, it's also overtaken the euro as a reserve asset. According to the European Central Bank, gold has become the second largest global reserve asset, trailing only the US dollar. So, why is this happening? What role does gold really play in today's world? Will it keep climbing at this pace? And most importantly, what does this mean for the global economy and investors? Stick around, because in the next few minutes, we'll break it all down. To understand why gold is surging, let's start with a fundamental question. What is gold, really? Many people think the answer is obvious, a shiny, expensive precious metal. But gold is far more than that. It's not just material for jewelry or bank vaults, it's an asset with a unique role in human history. So, let's go back to the beginning. What is gold, and how did it become what it is today? Over the centuries, economists and historians have proposed various theories, but one stands out as particularly compelling: Carl Menger's theory of the origin of money. Menger starts with a simple concept, a barter economy. Picture this: for a trade to work, there needs to be a double coincidence of wants. That means the person receiving a good must want it, and they must also have exactly what the other party needs. The problem is clear. This system creates high transaction costs and makes trade inefficient, slow, and nearly impossible to scale. The solution? People began accepting certain goods not because they needed them directly, but because they knew those goods would be easier to trade later. This is called indirect exchange. For example, a farmer might accept silver instead of wine, not because they want to use the silver, but because they know silver is widely accepted and can be traded for something else down the line. Over time, different goods competed to become the medium of exchange, and the market naturally selected the winners, those with the best properties: durability, divisibility, portability, homogeneity, and, crucially, relative scarcity to prevent arbitrary supply increases. In this competition, gold came out on top. It wasn't just durable, divisible, and portable, it had something extra. Gold already had demand as a luxury and ornamental item, giving it value independent of its monetary use. Its supply was limited but relatively stable, reducing the risk of sudden inflation. Most importantly, gold packed a lot of value into a small weight, lowering transportation costs and enabling long-distance trade. Over time, gold evolved from a mere commodity to a monetary asset. Its widespread acceptance allowed it to fulfill the three core functions of money: a medium of exchange to reduce transaction costs, a unit of account to simplify economic calculations, and a store of value to preserve purchasing power over time. But the story didn't end there. As gold became the backbone of trade, governments stepped in, minting standardized coins to reduce verification costs and boost trust in the medium of exchange. These coins held intrinsic value, backed by a fixed amount of gold, eventually giving rise to the gold standard. For centuries, gold ruled global trade. It was a simple, almost elegant system. Each international currency was worth a fixed amount of gold, keeping prices and purchasing power stable. Exchange rates were predictable, and inflation was under control. Why? Because no one could print gold. This system inspired confidence. But it had a flaw: gold was hard to transport, and countries didn't price goods directly in gold. By the mid-20th century, after the World Wars and the need for broader coordination, the Bretton Woods system emerged. The US dollar was tied to gold, and other currencies were pegged to the dollar. You no longer needed to trade in gold, the dollar became a perfect substitute. Everyone knew how much gold a dollar was worth, and the US Treasury pledged to hold enough gold reserves to back its value. This made the dollar the world's dominant currency. But there was a catch. Economic growth, rising liquidity demands, and exploding public spending pushed the US to neglect its gold reserves. In the end, President Nixon pulled the plug, declaring the US would print dollars without worrying about gold backing. Many thought this would tank the dollar. Instead, the opposite happened. The US was the world's economic powerhouse, with unmatched financial centers and trusted institutions. The dollar became the new gold, the ultimate store of value. From the 1970s onward, it took on the role gold had held for centuries. Even as gold ceased to be a currency, its 5,000-year legacy as a fundamental asset endured. Thanks to its unique properties, gold transformed into a store of value, a hedge against inflation, and a shield against political and international conflicts. And that, folks, is why this ancient metal is shining brighter than ever today. Since Russia's invasion of Ukraine, global stability has been rocked like never before. Conflicts in Gaza, tensions in Iran, clashes in Yemen, political shifts in Syria, US-China trade disputes, US protectionist policies, political turmoil in France, deflationary pressures in China, and Japan's uncertain political landscape have created a perfect storm. The world is on edge. But let's get back to gold. In this chaotic environment, gold thrives as a safe haven asset. When the world feels unpredictable, gold's millennia-long track record and tangible, limited nature make it a beacon of security. But there's another factor at play. Its main competitor, the US dollar and treasury bonds, has lost some of its credibility. For decades, the dollar and treasuries were the world's safe haven, sidelining gold. But over the past 5 years, that's changed. Headlines like exorbitant privilege, can the US dollar maintain its global dominance? Are becoming more common. We're not saying the dollar will lose all trust, but the frequency of these stories signals cracks in its dominance as a safe haven asset. Why is this happening? One key reason is sanctions on Russia. Remember when Russia's dollar reserves were frozen during the Ukraine conflict? That move left a mark. Other countries now worry the US could weaponize the dollar in the future. As a result, many are questioning whether relying so heavily on dollars and treasuries is wise and are looking to diversify their reserve portfolios. Their top choice? Gold. But that's not all. The US's expanding fiscal policy and ballooning debt, now exceeding $37 trillion, or 120% of GDP, are raising doubts about its ability to manage its obligations. Credit rating agencies agree. Moody's recently downgraded the US from its AAA rating, citing rising borrowing costs. Policies like the Big Beautiful Bill could add $3.3 trillion to federal deficits over the next decade, according to the Congressional Budget Office, though the White House disputes this. The dollar's challenges don't stop there. The Federal Reserve's independence is eroding. Traditionally, the Fed was seen as insulated from political pressures, tasked with maintaining monetary stability and controlling inflation. But recently, that independence has come under fire. Take comments from figures like Donald Trump, who has publicly criticized Fed Chair Jerome Powell, saying he's always late and wrong and calling for his ouster. When markets sense that monetary policy might be swayed by political interests, fears of future inflation grow. And when inflation rises, the dollar loses value, while gold holds its purchasing power, making it an attractive alternative. Some experts go further, suggesting that if political pressures on the Fed intensify, gold prices could soar to $5,000 per ounce, according to Goldman Sachs. Lower interest rates, which Trump has pushed for, would only fuel this trend. Why? Lower rates reduce returns on traditional assets like bonds, lowering the opportunity cost of holding gold, which doesn't generate interest. The numbers tell the story. In 2020, central banks bought 255 tons of gold. In 2021, demand rebounded to 463 tons. In 2022, purchases hit a record 1,136 tons, followed by 1,037 tons in 2023 and 1,045 tons in 2024. In the first half of 2025, central banks snapped up 410 tons. Over time, gold's share of global reserves has climbed toward 25%, while the dollar shows signs of weakening. Gold has already surpassed the euro as the second largest reserve asset. What's next? Will gold keep rising? Most likely, yes. Deutsche Bank recently raised its 2026 gold price forecast to $4,000, citing continued central bank buying and falling interest rates. A global survey of central banks found 95% expect their gold reserves to grow in the next 12 months, with 72% anticipating a higher share of gold in total reserves within 5 years. Markets are also betting on further rate cuts, with Polymarket showing an 83% chance of a 25 basis point cut at the Fed's October 29, 2025, meeting and a 73% chance for another in December. The OECD agrees, noting the U.S. economy is cooling, with growth projected to drop from 2.8% in 2024 to 1.8% in 2025 and 1.5% in 2026. A weakening labor market and inflation slightly above the Fed's 2% target, at 2.7%, provide room for further cuts. The Fed's recent 25 basis point cut to a 4 to 4.25% range signals a willingness to ease monetary policy. Why does this matter? Beyond being an investment opportunity, gold's resurgence is a barometer of deeper shifts in the global monetary system. Each price spike and central bank purchase reflects a move away from the post-Bretton Woods order. As countries diversify reserves to hedge against dollar volatility, gold is reclaiming a starring role. That said, don't expect the dollar to vanish. Its liquidity, ease of transfer, and deep integration into global trade, debt, and financial markets make it irreplaceable for now. Gold, while a strong hedge, lacks the practicality for international transactions and doesn't generate yield. Other currencies, like the euro or yuan, face their own hurdles and aren't ready to take the dollar's crown. So, what do you think? Will gold keep climbing? How high could it go? And most importantly, what does this mean for the future? Drop your thoughts in the comments below. We post new videos every week, so subscribe if you haven't already to stay updated. If you enjoyed this, give it a like, and we'll see you soon. Take care.